One of the highlights of the end of 2012 was the way that the banks soared despite rather mixed fundamental news. Lloyds Banking was one of the winners as well, but you can see how during January and February this year there was a bull trap double top just above 55 pence, and we've got a sort of M-shaped reversal with a neckline at 50 pence and a gap down today in the wake of the Cyprus shocker. So the view at the moment really would be that unless there was a sustained move back above the top of the gap around the 50 pence mark, we will see some downside on the stock, probably down towards the floor of a September rising trend channel at 46 pence. Although at the moment this is probably the worst case scenario, there is a chance, I would suspect, that the shares will push back above the 50 pence level. But still, as things stand, unless we see a weekly close back above 50p, the risk is down to 46 pence. Staying in the financial area, and we have hedge fund manager Man Group, which has really been on the back foot fundamentally and technically in the recent past. This situation has only really been repaired over the past couple of months in the wake of a cross between the 50 and 200-day moving averages. 50-day line shown here in blue, 200-day line now rising in bullish fashion, just under 84 pence. My view is that the floor of the price action is level with the 50-day moving average at 98 pence, and this is a July rising trend channel, and that really, while there is no sustained price action back below the 98 level, we could see a best case scenario target as high as £1.20. Probably for trading purposes you want to have a stop loss just below 95, the initial March support area, but nevertheless you're risking 4 or 5 pence to try and make 20, which seems to be a reasonable prospect. If you're cautious, you'd wait for the RSI to get back above 50. It's currently at 48, and also you'd probably wait on an end of day close back above the 20-day moving average at 101 pence. So a constructive look to Man Group, or a continuation in the recovery there from below 70 seen over the next few weeks. Onto the smaller side of the market, a smaller area of the market, we've got Cadogan Petroleum. Here, my theory is that we've been treated to a January and February bear trap below 13 pence, and that the real support here for the stock is at 13 pence level with the 50-day moving average shown in blue here. The implication is that while there's no weekly close back below 13, we should see further constructive moves here. The bullish idea is also backed up by the way that over the last month and more, we've seen RSI consolidation well above the neutral 50 level. In fact, 56 is just about my preferred RSI buying area, mid-50s, upper 50s. So really, the message here is above 13 pence. I'm looking for a rebound towards a July resistance line and the 200-day moving average just under 18 pence over the next, well, I suppose 1 to 2 months at the most. If it doesn't happen by then, probably it's not going to happen. Finally, there's Jubilee Platinum, where there's been a real roller coaster ride here, horrific spikes and pullbacks from the 12 to 13 pence zone. So rather obvious that that is going to be the level to, or the area to beat over coming months. On the downside, we've got a probable falling line of support rebound just through 7 3/4 pence, which means that November-December price action below 7.5 pence is probably a bear trap. At least from a trading perspective, you'd say that while above 7.5 pence, 7 3/4 pence, Jubilee could be staging a turnaround and then flip back up to top of the range at 12 pence. But really, another dip below 7 pence over the next couple of months, and you'd have to say that that the chance of Jubilee ever fulfilling its bullish credentials looks rather bleak. But at least at the moment, we've got another chance here of a straightforward range reversal, and the longer it stays above 8 pence, the better.